Alrighty, folks, we finally got this thing going. I'm going to tell you before we start. So first off, I'm Adrian. I'm Adrian Manz. You guys all know me. A lot of you guys are boot camp alumni. A lot of you guys are here just sort of getting ready for the boot camp in June. Some of you are considering going to the boot camp in June. But all of this is about stock trading, and all of this is about sort of a portable lifestyle, a portable business. So, as you know, our house in the Palisades burned to the ground, right? So Pacific Palisades, we were part of that mess. And the caveat of today's presentation is going to be that we are living in our vacation house down on Balboa Island, and wait for it, they're putting the utilities underground. So this is why we didn't do it last week or the week before. There is just nonstop noise, and I just decided we're going to live with it. Okay, so if you hear grinding or you hear pile drivers or whatever's going on, it's because they have decided the electric lines have to go underground, and we're sort of we're going to grin and bear it. But if you're in the room all day with us, you already know that sometimes the noise gets out of hand. But I think we can still get through this presentation and get you in front of what it is that I want to show you today. So, with that said, this has been some chaotic stuff, right? The markets have been just off the hook. People who are long-term investors are freaking out. They're calling me. I don't know exactly why they're calling me, because they know that I don't have long-term relationships with stocks, period. But one of the things that we've been talking about is, a lot of people call me up and say, well, I'm interested in doing some trading. I'm interested in getting in front of opportunities for profit from this volatility instead of just watching things go down the drain. I've got friends who are swing traders. I've got friends who are notable swing traders, right? People who are, have really been out there for a long time, who, are now saying, well, it's times like these where, I can see why an intraday trader or a day trader really has a significant advantage when it comes to dealing with this kind of volatility in the markets. There is no political statement here. It has nothing to do with where anybody's politics lie. This can happen anytime, any place. Anytime there's geopolitical uncertainty, you are definitely going to get headline shock, right? Things are going to drive the market in and out of range sort of repeatedly. And this is not unlike the first time that we had the tweets, the Donald Trump tweets, but it's also not unlike things that happened during the Bush administration, the Clinton administration, Obama. It's all about when banking stuff happens, right? 2008, when all those headlines were driving the markets, when terrorism happens, when all these horrible things that can happen in the world really influence what happens in the markets. And that's when you can use intraday trading to get in front of opportunities instead of feeling like you're in front of a freight train all the time. So let's get into this. Let's look at this stuff back here. Let's look at staying ahead of the chaos and learning how to profit from the volatility. I've got about an hour for you today. I'll take questions, and if you don't feel like you caught something here that you were able to put a question up about in the room, then just go ahead and text me or call me at 310-804-2248. So I'm happy to talk about this stuff afterwards with y'all. All right, so let's go and get started. Here is the whole deal in a nutshell. So if you guys know us, then this is going to be a little bit of a rehash of what's already going on. But we've got a bunch of people here who aren't really familiar with Julie and myself, aren't really familiar with Trader Insight and what we do. Julie and I have been involved and have had a passion for the markets since the early 90s, the mid 90s, when we were in graduate school. And we have always been very, very data driven. So when we were graduate students and working on dissertations and working on the projects that were going to lead us down the road that we eventually wound up on here, we were looking at the world of behavioral finance. So our PhDs are psychology, organizational behavior, social psychology, but really our focus is behavioral finance. So Julie sort of specialized in that before I did, and really embraced most of this stuff when the texts were still like in German. And I speak German, she doesn't. So that tells you, somebody's just really interested in sort of the social aspect of, what makes markets move. And, we developed a passion for this stuff, and we got real lucky and were able to work with the New York Stock Exchange and get in front of a bunch of data that people, at that time didn't really know how to access. And it gave us, not just access to the floor of the exchanges, but it gave us a different perspective on what goes on in the market. So we were looking at this and we said, well, wait a minute, markets are driven by people, and people are driven by some basic instincts, and it's, fear and greed and all that stuff that you already know about. But there's a person on the other side of every trade. And this interaction that we had with the NYSE was very much about like understanding how that relationship really is, how that develops. What is it that that makes a trade? Well, there's a guy on the other side of the trade, and there's other people on the other side of the trade. There's personalities, there's psychology, and people's psychology is really what's driving the market right now. Market did not drop thousands of points because the market dynamics inherently changed. Market dropped thousands of points because people freaked out about something. They were looking at these tariffs and said, "Holy cow!" Right? It's the world's coming to an end. We have to get out of all these positions that we're in. Hedge funds were closing out of positions. Everybody's closing out of positions. Then all of a sudden, the psychology is, oh, you know what? It might not be as bad as we thought it was going to be. Let's pile back into this thing, right? And that human psychology of, I'm afraid I'm going to lose, and then I'm afraid I'm going to miss out when it comes back, that has always driven, whether you're talking about a time when we were trading tulips or you're talking about, what's going on in the markets now, it has always driven human behavior. We have written just lots of stuff over the years. So like I said, we've got our PhDs, and one of the things that you focus on when you've got a doctorate in anything is you publish. So we enjoyed publishing articles in magazines, periodicals, journals, things that talked about, well, what is it that drives the market, and how can we narrow it down to things that are identifiable, things that are statistically provable, things that you can go and sort of wrap your head around and say, there's a method to this whole thing, and there's a way to show whether or not there's a statistically significant edge in doing something a certain way. So that's everything that we do relates back to our careers or our education as statisticians, our education as researchers, and we love to go through and we love to research things, and we love to put together our ideas. And as a matter of fact, now, Around the Horn and Trade Secrets, those were two books that I wrote that were purely about the statistics of this whole thing, and then boiled down to here's the patterns. Those aren't available right now because those burned up with the rest of our business was up in the Palisades, and our inventory was housed up in the Palisades. But come next year, I guarantee you there'll be a new version of Around the Horn out there. Around the Horn was originally called a multivariate analysis of covariance in the United States equities markets. And we went and redid the whole thing because effectively, my publisher said, look, how many copies of this thing do you think your mom's going to buy? Because there's no way we're selling a book called A Mancova of, anything. So what we did was we took the markets and we said, what do we like in terms of an analogy? What do we like in terms of a metaphor? What do we like in terms of you can look at something through a lens? And my publisher, George Stillwell, who's a good friend to this day, He said, how about football? And I said, I'm much more a baseball fan because I think that the relationship between what goes on in baseball, to the blind eye, baseball looks like there is no strategy. You get up to the plate, you swing, you hit or miss, right? Something, you always try to knock it out of the park. That's not how baseball is at all, right? There's a lot of strategy in baseball. There's a lot going on behind the scenes. There's a lot of statistics going on behind the scenes. Everybody's seen Moneyball and all that stuff. So we wrote the book around this analogy of baseball. So things like a statistically significant expansion of range and volume that you would normally prove with a test now is called a fastball. And the fastball is something you can identify on a chart. You can look at the chart and it's very easy to see. It pops right out at you. And I told Mike in the room today, I said, as he's going through and he's working on his boot camp materials, and he asked, he says, well, what do you think of this fastball setup? And really what I wanted to say was, well, what do you think of it, right? Does it jump out at you? Does it pop off the page when you're flipping through charts? Because even though you can get my scanners for, they've been licensed all over the place for Metastock, TradeStation, Realtek. There've been scanners out there over the years that will just pick these things off on all the major platforms. They'll tell you what looks like a fastball setup. What's important is that you see it, so that you see things in the context of what they are. And if they're obvious enough that when you're flipping through charts, you can flip through 1,000 charts in, say, a half an hour. And when they're so obvious that they pop right off those charts at you and you can spot them, then that's where you don't need the statistic. The statistic's already baked in. So your eye is as good as catching that statistic as SPSS or SAS or any of the statistical packages are. So we managed to boil it down to these easy to identify patterns. We've been trading the same patterns since 1996, 97. We started, Trader Insight in 1999, I think. And, Trader Insight was our vehicle to focus on what it is that we were trained to do. So I said to Peter Drucker, Peter Drucker was was on my committee. This guy was huge in my life. And I said to him, well, when I graduate, I think I'm going to go work for McKinsey and Company for a couple of years. I'm going to go and see if I can get in the investment banking side of things, work on merger arbitrage, work on, corporate culture things. And he said, look, you put all this time into developing these strategies and developing this tactic for the markets. And take it from the highest paid business consultant in the world, because he knew who he was. If you start something and it's profitable and it shows promise, don't give up on it. Don't give up on it to go work for somebody else. And our big conundrum was the way that we saw life going. We would work out in the field as consultants for, however many years, maybe 5 years, 10 years. And then we thought for sure we would be teaching at a university. So we both taught university classes. Julie did a little bit more of it than I did after grad school. She was a professor in the UC system, in the Cal State system. And at some point she said to me, well, we could transfer this stuff, this knowledge that we have of the markets, to our own accreditation program, to our own university, so to speak, because there really is nothing in the university system that looks at the things that we look at. So, UC does have a couple of behavioral finance kind of courses, but beyond that, the best behavioral finance we could come up with was going to be stuff that was self-contained here in what it is that we do. So we put together this coursework. There's a bunch of courses and, deep training at Trader Insight. You guys who are coming to the boot camp, you already know it's a 650-page manual. It's 40 hours of online training. And then it is, 3 full days of live trading. We're going to do it in Miami Beach again. We always do it in Miami Beach because the time zone is right. And, by the time you leave there, you've got a mastery level proficiency in the markets that you're just not going to get anywhere else. So we use that as our stump, right? We get out there, and you guys know me from Traders Expos and money shows and the Italian Traders Forum and the German stuff, and all these places around the world that we've spoken, the London Stock Exchange. We've been regulars all over the place, and we're coming back in 2025 as an online show. So we were live, and this was stuff that we were doing with network television. So we were out there and we were doing this Trader Nation stuff, and Trader Nation was all about the psychology of trading, deep dives into trader psychology. It's for various reasons it's not possible to. For one thing, we can't head up to Hollywood to. We actually did that on the set of The Mandalorian, is where that's filmed, and traveling hours on end to get up there to do a live show is not going to be in the cards this year. But we are going to be doing something from here on Balboa Island, and if you want to send us a trader psychology question, you can just, record it on your phone, do a little video. Hey, Adrian, Julie, I've got a question for you. I've been trading and, it's hard for me to stay unemotional when I'm in the markets, or it's hard for me to divorce myself from what I used to do when I'm in the markets, or, any kind of a thing that you want to talk about. Why is it hard for me to keep my stops in place once I'm in a trade? Why do I go and ratchet profit objectives down instead of letting my trades naturally go to the profit targets? Send us that, Adrian at traderinsight.com or Julie at traderinsight.com, and we will answer your questions. So we will put these things out as regularly as we can get some content, and we'll get this baby going again. It was a really interesting show. We did great stuff on sort of gambling psychology, guys who come into it as gamblers, guys who come into it as pragmatists, guys who come into it, as perfectionists. It's a really interesting content area, and it's interesting to talk about because it's something other than just saying, I think the market's going up or the market's going down. So with that said, right before we dive into looking at these volatility patterns today, I put this up here because, we're coming up on another boot camp. It's a year-long program. We work with people. We only work with 25 people at a time, and so it's a very different kind of a program than one of these things where you're going to get in there and there's thousands of people taking some canned course. This is a very active program. This is, you've got my phone number. You're calling me. A lot of you guys, I'm already talking to, and what I put up here are some shots of the boot camp. And what I want to say is, as you go around those rooms and you look at the guys who have been through the training, the thing to keep in mind is we've all got a different psychology that we use as our heuristic for the markets. And, the guy in the back in the red shirt, he's a food photographer. He's got a great business, did these magazine spreads and all this kind of stuff all of his life. He had a great business. He's got a way of looking at things where everything has to be sort of picture perfect, right? He tinkers until everything is just the way that he wants it. The guy next to him on the left is a cop, and he's got a very assertive, straightforward approach to the markets. He's got a different way of looking at things than the guy right in front of him, who happens to be a gambler. And the gambler is looking to, he's always looking for action. Whereas John, the guy in the back row there, the second guy, he has got a very, I'm going to put the pieces of this puzzle together. I'm going to have a definitive plan of action, and I'm going to go do it. John, the guy in front of him in the black shirt with sort of the buzz cut, he's very much about, if something's moving, I want to be part of it. And I can go around that room. I can go around any one of those rooms there. There's lawyers, there's physicians, we've got engineers, more engineers than you could ever count, and a Latin professor. And it's like, as you go through their personalities and you go through who it is you have in front of you, what you know for sure is their psychology is going to affect the way that they see volatility, the way that they see the same trade that the guy next to him is looking at. Now, the third guy in there in the black shirt, that's our son Connor. So he's at all the boot camps. If you guys haven't been to one, then, well, if you do go, you'll know him because he's been to every one of these things since he was 3 years old. And, we travel with Connor a lot. But all these people are great people. They're fantastic. They're all good friends after the boot camp. They're our good friends. We vacation with them. We talk to them all the time. But they all bring something different to the table. They've all got different strengths, and they definitely all have different hang-ups. So what we try to drill home in our process is trading's a business, and you need to treat it like a business. And the only way that you're going to figure out where you are or what you can capitalize on right now is to go and separate things into sort of the logical sections of what it is that you're doing. So we've got NYSE program trades. Those are those around the horn trades. These are the core trades in what we're doing. It's doing great for the year, but it's not doing great for the month. So for this month, it's up. It's great. It's fantastic that it's up at all, but it's up a couple points on the month. Points are percentage points, of course, right? But it's not doing the kind of numbers that it normally does. Why? Because those NYSE program trades are sensitive to the volatility of the markets. Same thing with the NASDAQ program trades. So the program trades that we're firing off, you guys know them as XRV, or the NYSE trades as the around the horn plan. Those trades are more difficult to get a grip on because if you're going to have big gaps every day because the market's going crazy, well, then what's going to happen to your programs? They're going to blow out. So if I've got an entry at $55.70 on something on the NYSE and the market opens and it gapped down to $52.70 or it gapped up to $57 or whatever, that's going to impact my ability to make a living with that strategy. Same thing with the XRV trades. The opening gap reversion trades, we're going to talk about those today. Those are 2 standard deviation opening gaps. And those 2 standard deviation of volatility gaps, they get you in front of a fantastic statistic. Problem is, when everything gaps every day, it takes an awful lot to generate a 2 standard deviation move because, well, we'll look at how they're calculated in a second here, but that they go away. So for 2 weeks, we didn't have really anything that qualified for that trade. And when that's a bread and butter trade, like it is for a lot of our traders, that's very frustrating. And if your psychology is, well, I need to find something that's moving, and you're not paying attention to the fact that market isn't moving, it's being moved, then you got yourself a problem, right? Because you're going to jump off of what you know and do something you don't really understand, and now all of a sudden you're in a position to generate losses. But what we do is this other component, order flow trading. So the order flow trading that we do lets us have a reset. So if you've been in the room with us for the last, couple months here, then you know that, one of the hallmarks of how we interpret the data is we trade the opens. Once we traded the open, where we're looking at those opening gaps, the next thing that we do is we take a break, try to go for a walk for an hour, even take a nap, whatever it is. We're going to be back at 8:30 Pacific time to refigure what's going on in the markets, because then we're going to start looking at order flow. And this order flow trading, which is one of the things I'm going to show you today, is definitely something that's not so sensitive to all the geopolitical shock that goes on in the markets, right? This headline-driven markets affect the opens. Order flow trading is what happens once the markets settle in. We've got a roadmap for just about everything that we do. And if you're, looking at the way that we trade the markets, then from left to right here, right, we've got pre-market trades. We've got an Apple trade that's a market maker arbitrage trade. We've got an Apple trade that is a volatility band trade. We've got an Apple trade that accounts for just about everything that can happen around an opening bell. That is our first thing in the morning that we focus on in terms of our energy. We've got XRV, We've got around the horn, the NYSE trades. Those are program trades. We put those in before the market opens. As long as there's not going to be a 300-point gap, 500-point gap, we just let the market take care of getting us into and out of those positions. So today, for instance, Julie's not here. She's up with, Connor still goes to school he actually goes to school up around Manhattan Beach there. And, on Thursdays, she drives him up there. So he's in high school, doesn't want to drive. That's a whole other story. But, so she'll drive him up there. Mondays, she drives him up there, Mondays and Thursdays. And Mondays, we don't trade anyways. So we know that that's the way that the schedule goes, because Mondays, there's all sorts of bad volatility from stuff that happened over the weekend. But, Tuesday, Wednesday, Thursday, Friday, this is our schedule. So at the opening bell, we get in there and we execute our NASDAQ opening trades. We have a plan that's set up. All you guys get the plan. All you guys who are on the trading plans, all you guys who are boot camp alumni, you've all got those trading plans and they're sitting right in front of you. You know what to do with them. At the 5-minute mark, we start trading the opening gaps. And we're going to talk about how those are calculated, because I have a lot of questions from sort of the newer folks. You're starting to work your way through the boot camp materials, and what are we doing here with these Baltimore chops? What are we doing with these 2SD opening gap trades? We're going to look at those in a second. And then after the first hour is up, we take a break. We monitor the NYSE trades, we monitor the NASDAQ trades, and when we come back, we start focusing on the volatility. We start focusing on a market now that has settled in. So the goal today is to get everybody sort of on the same page in terms of what it is we're looking for when we are trying to isolate the volatility in the market, when we're trying to figure out where do we think the market's going, and how can we anticipate what the market's going to do without having to make a bunch of decisions that maybe we aren't, really ready at 6:30 in the morning here on Pacific time to be making. So I'm a big advocate of planning everything. Plan the trade, trade the plan. That was our slogan, I think, before it was anybody else's. So, back in the mid-90s, if you have the coffee cup from before it was Trader Insight, it was just Peterson Manz Trading. We had our little trading firm. It was right there on the coffee cup. Plan the trade, trade the plan. That was our mantra from the beginning, and it is definitely still the way that we approach the markets now. So this first one, like I said, baseball analogy for everything. And, if you don't like it, it's just a 2 standard deviation opening gap reversion trade. And I'm going to show you why I called this a Baltimore chop in a minute here. First thing I'll do is show you what a Baltimore chop is. It's an old Baltimore Orioles trick, not the new Baltimore Orioles, the Baltimore Orioles of yesteryear. And this one has some qualities that are going to be very different than just about anything else that you're going to trade. We've got a scanner for it on the site. So if you are new to the boot camp, if you are going to join us in June, or if you're just a member of the War Room, make sure that when you log into the room, you guys can all get a trial to the War Room. I always say the same thing. Once you're in, you're going to stay in because it makes money, right? There's money to be made in that room every single day as long as you're following the logic of what's going on. So that's the point of today, is to talk about what the logic is. There is no black box. There is no secret here. It is all about, just getting in front of opportunity, staying in front of opportunity, and picking the opportunities that are right for making a profit. So let's take a look at Baltimore chop. Baltimore Orioles had a trick. If they had a guy who had a hard time getting to base, or had a hard time hitting the ball out into center field somewhere that it couldn't be fielded quickly, or couldn't be fielded back to the base, then what they did was they had him spike the ball down into the ground, pop it over the pitcher's head, and by the time you could field the ball, the player could be on base. And I'm going to show you in a minute here why I think that looks just like the opening gap reversal. And if you focus on the ones that look just like that spike down into the ground, or the inverted version of the spike, then you're going to be in pretty good shape. So first off, we're going to look at range and true range. When we first started trading this, we used the implied volatility of the front month contract of every single stock on the exchange to determine which ones of these were suitable trades. Later, we started looking at range. Range is today's high minus the low. So, right, is there a way to look at a chart and say, well, if that's the high price and that's the low price, then how much would it have to gap in order for it to be statistically significant? So if that high was 50.10 and the low was 49.40, you had 70 cents of range for the day. And this is sort of what they do with Bollinger Bands. And I mean, Bollinger Bands are just the same kind of a statistical manipulation. You're just looking for 2 standard deviations of something. And in that case, you're looking at 2SD at closing price. This was not a good proxy for volatility. What is a great proxy for volatility is true range. And true range is going to be the high minus the previous low close, or the low minus the previous close. So the absolute value of one of those, or the range, whichever is greater. So either the high minus the low, or the high minus the previous close, or the low minus the previous close. And what that gives you is something that a statistic is actually interested in. Now you are looking at what is an important move for this stock in terms of the price action that we normally see, including gaps. So if you have this high and you have this close, and that second bar is the same bar we looked at a minute ago, well, now if the high was $50.10 and the previous close was 49 bucks, the true range for that day is $1.10. So now you want to figure out, how do I fit this into a model? And mind you, that's not average true range. Okay, this is true range. So average true range ATR, if that's all your software will provide, because you can plug any of this stuff into your software if you want to. Average true range, you would just set it to 1. So you would set the look back period to 1 instead of 10, or whatever it is currently set at. And by setting it to 1, you would just be looking at 1 bar worth of data. You're going to put it into a statistical model. So any statistic requires assumptions. And here, your first assumption is volatility data is normally distributed. And if you're not a statistician and you're falling asleep, don't worry about it. This is the last time, I promise, you're going to have to look at this stuff. Normal distribution just means it fits under the bell-shaped curve. I'm sure you've seen a bell-shaped curve. I'm sure you remember what a bell-shaped curve is. Trust me when I say volatility data normally distributed. So if you're looking at the VIX and the VIX is at 25, the VIX is at 27, right? What do you assume is going to happen with the VIX? It's going to come back down. That means it's mean reverting. So anytime you have data that's mean reverting, what you're assuming is you've got a normal distribution. True range is a proxy for volatility. I promise you, true range is a great proxy for volatility, especially in this case, where what we're looking for is what happens when a market gaps. And finally, volatility is mean reverting. And mean reversion in volatility data has been proven for the last probably 100 years. There is stuff out there everywhere that shows you volatility is definitely mean reverting. When you have all these things in place, when you can satisfy the assumptions, or you're willing to say, I think those assumptions are satisfied, it gives you access to this guy right here. That's a standard normal distribution. In the middle is your average, right? That mu, that funny looking U down at the bottom, that just means arithmetic average of all your data. Go out 1 standard deviation, you've accounted for 68% of all the variability that you expect to see. What that means is that you think that based on what's happening in the data, you're going to have a move back toward that average, back towards the middle, 68.2% of the time. Does that mean it's going to hit the average? No, it just means it's going to move back toward the average. If you go out 2 standard deviations, now you're in the 95% confidence interval of that mean. That means you're 95% confident that you're going to move back to at least 1 standard deviation. You're going to move back somewhere in the range, maybe all the way to the mean, or you're going to move back maybe even further than the mean. It's not about closing a gap. It's not about pinpointing exactly where you're going to go based on the statistic. It's based on understanding that if you've got a bunch of data and it's normally distributed and you've got an average in the middle of that data, then you're going to have these red balloons that represent periods of high volatility, and you're going to have these blue balloons here that represent periods of mean reversion. And those things right there are just indicating you're going to move back toward the average, and that's where you have the opportunity for a profit. So we've got a formula, and the formula just says that one standard deviation is calculated by you take the sum of all those true range data points. So for 10 days, I use 10 days worth of true range. We're going to go, for 1 through 10 minus the average of all 10. You square it to get rid of a negative number. You divide it by 10 minus 1, 9, right? That's degrees of freedom. You take the square root to get rid of the square, and that gives you one standard deviation. And this right here is what the formula then inputs into the equation. So if on day 1 through 10, you've got that data, right? From $1.03 down to $1.97 of true range, you can plug that in for 1 through 10. The average of those 10 numbers is $1.25. You're going to subtract that from each number before you square it. You sum them up, you square it, you divide it by n minus 1. That gives you one standard deviation, 49 cents. So what that tells you is, if I gap tomorrow 98 cents beyond my average, so 98 cents plus $1.25, that's the gap that I need to see tomorrow. So $2.23 of gap means on this particular stock, I'm out there and I'm ready to anticipate a mean reversion. And so if these are 5-minute bars, so you're coming in on the left side of the chart here, and from the 5-minute bars, what you're looking at, up in here is the last 5-minute bar of yesterday's session. Then it gaps down, and that gap move lower represents a 2SD move in terms of the volatility that we expect to see. So now we just follow this down. You follow down one bar at a time on the highs. So this is for a gap lower. I'm going to show you both of these for a gap higher, for a gap lower, how they work. But you're following down until you get to the deepest bar in the gap. And usually what you're looking for is something like you see here, where the deepest bar in the gap, the lowest high, has a narrower range than the bars before it. So there's an exhaustion in what's happening. And that exhaustion says, if we get up above that high, then what we're looking to do is fade that gap. Now we're going to buy this stock, and we're going to buy it above that high, and we're going to target something significant that happened in the first bar of trading. Why the first bar of trading? Because in that first bar, that's where we saw the sell-off, right? So once we get back to that point, what we're anticipating is those sellers will likely still be there, and we want to take our profit and get out of their way. And, why does this whole thing look to me like the Baltimore chop? Because just picture that batter spiking the ball down into the ground, pops up over the pitcher's head, right? And that's your perfect setup. So now let's look at Qualcomm. Qualcomm is our gap from this morning. So in early trading today, right, we had a bunch of earnings gaps, and earnings are definitely what you want to focus on. You want to stay away from bad news like, CEO killed a guy or CFO stole a bunch of money and he's hiding in Argentina somewhere. Any of that kind of stuff shifts the distribution. That's not a normally distributed distribution. You stay away from it. What you want to look at is run-of-the-mill news. So, earnings are the best. Earnings are the place that you can really, capitalize on some things. Qualcomm spelled wrong there. I apologize for that. Qualcomm. But you see here, we had a gap lower on the stock. And, here's your first high. And it doesn't have to be this perfect 1, 2, 3 setup. It's 1, 2, 3, 1, 2, 1, 2, 3, 4. All you're looking for is this move that gets you down, and now you've got the deepest high of the morning. And in this case, what we're going to say is, all right, if that's the second high is the lowest high that we're going to get. Then that level at 136.51, if it violates that in the next bar, we want to get long right there. And then we want to start putting together the pieces of the puzzle and say, well, where do we want to put a stop loss? Initially, we'll put a stop down at the low of the bar that created the setup. So in this case, stops all the way down at 135.10. It looks like a big stop. It's really not, because as you know, if you're in the room, the first thing that we're looking to do after we get into the trade is ratchet the stop to a new position. So the new position in this case would be under the entry bar low. So by the time you're about 3 minutes into this trade, your stop on this thing winds up being about 136.20. But for right now, let's just look at these levels for what they are. We've got a target up at, ignore those other numbers, those are artifacts from something else there. We've got a target up at 138.18. And that's based on, as I said, something significant that happens in that first bar of trading. And if you look out on the right side of the chart, you see that green volume by price threshold there. That's a hierarchical cluster analysis of what happened in the volume, and that says that that's where the significant sell-off earlier started, and if price gets there, we want to be out. So we set this up as a bracket order, and this is how we manage to get through position after position on these things. We set them all up as bracket orders. So when you have 5, 6, 7 of these loaded up for the morning, you just keep dragging the order, changing the order. We've got a 136.51 stop for the entry. So stop and the limit, right? Stop price is where we activate, limit price, the worst price we're willing to accept. We've got a target, 138.18, and we have a stop loss, 135.10. So, what you see there is for, in this case, 500 shares, you've got a profit objective and a target initially, about $800, close to $800, and those things are the things that are just setting up the parameters for what you're going to do. It's a pretty much a one-by-one trade right here. And if we get in, then what we're going to do almost immediately, as I said, is look to ratchet the stop, get the stop up higher. And that's almost always the case, right? That when you're dealing with a mean reversion, you're going to be able to do that. Then on the short side of the market, we had front door. So FTDR today, this one gapped higher, same kind of a thing. Now you're just going to follow price and say this is the highest low of the morning. And this second bar is going to be the next highest low. And if after that second bar we trigger an entry, it'll be at $49.49. When we're looking for a stop, we're going to look up above that volume threshold out on the right side over there, $50.06. And when we look for our target, it's going to be down at that major inflection that the stock had when it opened. It went down, it ricocheted off $48.25, and then it shot higher. So if it gets back down to $48.25, we want to take our profit, and we don't care that it manages to go to $45.97. That's not the point of the exercise. What we want to do is focus on what is, on what we can derive from what's happening in the markets. And remember, you're trying to set up 3, 4, 5 of these things at the same time. You got a bracket order's out there, and it just says, look, this is the entry level for the short sale. This is going to be the stop price. This is going to be the target. And it goes out there and it handles all that volatility for us and manages to keep us in front of lots and lots of trades over the course of the morning that have the potential to be profitable. So the guys in the room, if you're in there and you're firing these orders off one at a time, then you know that the problem with just going and putting an order in and then trying to be discretionary about what you're doing is once this trade is on, you will have a tendency to just sit there and brood over it like a chicken. And what you need to be able to do is just let it go. Let it handle itself like any other program trade. Because what the key to being profitable in this volatile market, in any market, is to be able to just let things play out without your fingers on the keyboard. Because it's going to swing around, it's going to bounce around, it's going to do what it does. And in the end, your presence there is not going to do anything other than mess up the plan that you had, right? So just let them go. Just set up the trade and trade the plan. So now that's the first 5 minutes to about the first hour of trading is done. And we take a break. And we come back at 11:30 Eastern time. We come back at 8:30 Pacific, and we say, okay, now how do we go through and handicap what's going on in the market right now? And our focus generally is on the Magnificent Seven, on the QQQ, on trading. Some of our folks are trading the ES. We trade the NQ. But, you're doing the same kind of thing. You're going through and you're saying, well, what's going on in the market right now that I can capitalize on? And this is as simple as picking apart the volatility and saying, where is the order flow? So we're order flow traders. What our guys want to do is say, look, I've got a level of support and resistance here. This support and resistance level is backed up by some volume by price data that says that clearly there's nothing below this that's significant. And if price gets back down here again, what we're going to expect is a push higher. And the first place that we're going to expect to push higher is right here. So we're just going through, and over the course of the day, we're evaluating what's going on with price, what's going on with volume at that price, and can we go and identify very, very specific levels of support and resistance that look like they're going to be inflection points. And now today Meta made a big move higher, so our bias on the session was up. We were looking for, moves that would get back up into the range. And, over the course of the day, what we're doing in the room is showing you on a spreadsheet, okay, here are all the trades that are lining up. Here are all the trades that we anticipate. And based on what's happening in the markets, these are the levels that we're looking to go long. These are the levels we're looking to go short. But always what we're basing decisions on is confluence. So in this case, the confluence is the volume by price, the threshold levels. Here's your volume weighted average price for the session. Right now you start seeing a different picture. You start seeing, where do we think price is gravitating to? Then we use anchored volume weighted average price. And we say, all right, we know where the VWAP for the session is. How about the VWAP over the course of the session at each one of these swing points that we see during the day? What this does is gives us even more reason to have the courage of our convictions for those targets and entry thresholds, because what we see is during the day, every one of those levels has acted to be a gravity point for price action. Line that up with the volume by price data and all your support and resistance data, and you've got a recipe here where you can go and put in ahead of time exactly what you think is going to happen before it happens. So you can see these are the trades that we put out there for the guys in the room. These are the threshold levels. The ones in yellow, those just didn't hit, right? So those never triggered entries. But as you're looking down the list here, what you see is there was better than $10 per share of opportunity that you could get in front of today just by watching for the threshold levels that you identify on a chart, threshold levels that tell you where price is likely to go. Here was Google. So if you're in the room today, right, we had Google lined up. 162.41 was the threshold level that we were focusing on during part of the session. 163.10 a little bit earlier, 163.10 up to 163.37, not a game changer. 162.41 up to 163.10, better trade. 162.41 up to 163.37, even better. Amazon, same kind of a thing, right? We've got the 188.97 pivot line. When price gets down to that 88.97 pivot, what did we have on the sheet? We're looking for 189.74. Once it trades through 89.74, what are we looking for? A move higher again up into 190.86. All day, every day, this is how we're handling the volatility. We're going through and we're isolating areas that we think are going to be inflections. And on a bidirectional trade, something like Tesla here, you can see we had 282.82 as a long entry, and we had 284.33 as a short. All you had to do was trade Tesla back and forth in that range, and you're able to get 4 or 5 good trades out over the course of the session. Up above 287.70, same thing, right? If it hit the blue line, if it hit the pivot line and started tracking higher, you're looking 289.13. Once it was down below there and trading right at that volume weighted average price, 286.14 up to 287.48, that was the range you were looking at. Tesla is a good trade in either direction versus, some of these other trades, which we handle much more unidirectionally, right? So Tesla right now is pretty volatile. It's subject to a lot of sort of up and down price action, QQQs, same kind of a thing. Qs, what you want to do is just watch for what the most recent trend was on the session. And, if you keep your eye on the ball and you stay focused on what's right in front of you, right? So as you're looking at the right side of that chart from 11 o'clock on down to 12:45 there, trend is down. Want to focus on moves lower that come back to a threshold level and then move lower again. So the first one gets down to 286.14 up to that pivot line. You got an opportunity for a short back down to 286.14. So 287.48 down to 286.14. Gets down in there, gets down to 282.82, back up to 284.33, opportunity for a short sale. So you're just focused on what is, not what you'd like it to be, not what you think it should be, but you're getting in front of the volatility and you're letting the volatility play out and putting yourself in just a good position then to profit. And as I said, we've got these out there all day, every day on our, on the blotter in the room. You just have to look at the spreadsheet. It's a Zoom room, so you can just blow up that section of the room and you can see which ones are coming up, which ones it is that Julie and I are going to focus on next, and the guys in the room are going to focus on next. And it should give you a really good feel then for how to deal with the volatility. So if you're not in the room, I know most of you guys, you really should have access to it. If you don't, you can come to traderinsight.com/trade. We'll put you in there for a couple of weeks, and you can see what's going on. You can see what the trades look like. But generally speaking, I think that once you're in there and you see the opportunities that we're trying to get in front of, you'll understand why this is really a good recipe for successful trading.